Welcome to The Explainer. The fundamental rules of financial risk are being rewritten as we speak. You see, the old fault lines we used to watch for, the ones centered around the big, familiar banks, they've shifted. So today, we're going to explore a new, much more complex map of financial danger and figure out why the next crisis might look nothing like the last one. Here's our game plan. We'll start by looking at just how much the financial world has changed since the 2008 crisis. Then, we're going to dive deep into the new kinds of risks this creates. Everything from these lightning-fast market meltdowns to massive threats from climate change and cyber attacks. And finally, we'll get to the big question. How on earth do we build a system that's actually strong enough to handle these new shocks? Okay, this sentence right here, this is the key to everything we're going to talk about. For decades, the story of financial risk was basically the story of banks. But that story has changed. A kind of quiet revolution has shifted the center of gravity, moving it away from traditional banks and into the huge, fast-moving world of financial markets. All right, let's step into this new landscape. What exactly is this world of market-based finance? And how did it come to be such a dominant force in the global economy? You know, this timeline tells a classic story of unintended consequences. The 2008 crisis happens, and the response is, logically, to crack down on banks with tougher rules. The goal was safety, of course, but the result was that trillions of dollars in financial activity just moved. It flowed into a less regulated space, creating this whole new class of financial giants whose hidden power was suddenly and dramatically revealed during the panics of 2020 and 2022. And here they are. The new giants, non-bank financial intermediaries, or NBFIs for short. Basically, they do a lot of the things that banks do. They manage money, they lend, they create liquidity, but they're not actually banks. We're talking about massive pension funds, insurance companies, hedge funds. You get the idea. They control trillions of dollars, but they operate without the usual safety nets, like deposit insurance. And they have become absolutely central to how money moves around the planet. Okay, so we've got these new players on the field. Now let's take a look at the new and, frankly, more dangerous game they're playing. This whole shift has created completely new fault lines in the global economy, with risks that regulators are, well, still scrambling to get their heads around. Now this is the crucial difference. With old school banks, the main fear was solvency, basically asking, will the bank go broke? But with NBFIs, the real fear is liquidity. It's not about going broke, it's about not being able to sell your stuff when you desperately need to. Imagine a crowded theater where someone yells fire. Everybody makes a frantic dash for the exact same exit at the exact same time, and boom, gridlock. Nobody gets out. That's a liquidity crisis. That's a market freeze that can bring the entire system to a screeching halt. And this right here, this is the recipe for how things can spiral out of control and fast. It's a vicious feedback loop. Anxious investors start pulling their money out. This forces the fund to sell assets to get cash. But those massive sales push prices down, which then triggers margin calls and spooks even more investors, who then also pull their money out. You see, it's a domino effect, where one little wobble can amplify into a systemic earthquake. And hey, this isn't just some theory on a slide. Let's look at a real-world example from that market panic back in March 2020, an event that's now known as the dash for cash. This number, 70 basis points, should honestly send a shiver down your spine. In the normally placid, predictable world of US government bonds, literally the safest investment on the planet, that is a seismic shock. So why did it happen? It happened because NBFIs, specifically money market funds, got so desperate for cash that they had to start dumping even their safest assets. It was the financial equivalent of the fire station's water mains breaking during a 4-alarm fire. And this just perfectly illustrates how interconnected everything has become. The trouble in the NBFI sector didn't stay in its lane. Nope, it spilled over and nearly broke the most important market in the entire world, the very foundation of the global financial system. This was a massive, blaring wake-up call for regulators everywhere. And just when you think things couldn't get more complex, they do, because layered on top of this already fragile system are two new kinds of threats that act as massive risk multipliers: climate change and cyber attacks. When we talk about climate risk, it's not just about storms and floods. It's actually a three-pronged financial threat. First, you have the physical risk, the actual damage. But then you have transition risk. What happens to your balance sheet when a coal plant or an oil field suddenly becomes a worthless asset in a new green economy? And finally, there's liability risk. That's the coming wave of lawsuits that could bankrupt companies. Each one is a potential landmine just waiting for the financial system to step on it. Now let's talk about the digital threat. This quote here says it all. Cyber attacks are not an IT problem anymore. They're a systemic financial concern. Think of our financial system like this crazy traffic intersection. It's this complex, high-speed network where everything depends on everything else flowing smoothly. One little crash, one blocked lane, and you get a massive pileup that gridlocks the entire city. Well, that's what a successful cyber attack on a key financial player looks like today. And again, this is not a what-if scenario. In November 2023, it happened. A ransomware attack hit a huge global bank, and it temporarily jammed the gears of the U.S. Treasury market. Yeah, the same market that almost broke back in 2020. This proved that a handful of hackers can now threaten the core plumbing of the global economy. It was a terrifying real-world demonstration of our digital fragility. But the most dangerous part of all this is that these risks don't stay in their own lanes. They collide. They amplify each other. Just imagine a perfect storm. An AI-driven cyber attack hits the markets right in the middle of an NBFI-driven panic. And at the exact same time, different data privacy rules are blocking regulators in the US, Europe, and Asia from sharing the critical information they need to stop the bleeding. That's the kind of complex, cascading failure we now have to prepare for. Okay, so we've mapped out this new landscape of fast-moving, interconnected risk. It all leads to the obvious question, right? What do we do about it? How do we build a financial system that can actually withstand this new reality? This is the central challenge for every regulator on the planet. Are we still fighting the last war? Are the rules we built for the bank-centric world of 2008 strong enough for today's market-driven world, which is also being hit with climate and cyber threats? The uncomfortable reality is the entire battlefield has changed. The answer isn't to just keep patching up the old system. We need a completely new playbook. The experts call it a macroprudential framework, which is a fancy way of saying we need to look at the entire forest, not just the individual trees. It means having a single, unified view of risk that stretches across banks, NBFIs, and all the critical infrastructure that connects them.
And building this new system really comes down to a few core ideas. It means having crystal clear rules, so when a crisis hits, there's no confusion about who's in charge. It means forcing agencies to share information so we can finally get rid of those dangerous blind spots. It demands flexibility, so we can adapt to risks we haven't even thought of yet. And it has to be global, so companies can't just go regulator shopping for the country with the weakest rules. All of this has to be built on a foundation of transparency to keep the markets confident.
So if you take one thing away from all this, let it be this. Our idea of financial safety is out of date. For a whole generation, we thought being resilient meant just building thicker walls around individual banks. But that's not nearly enough anymore. True resilience today means understanding the connections across the entire ecosystem, from a pension fund in London to a payment system in Tokyo to a data center in Virginia. The next test is inevitable. The only real question is, are we prepared for it?